If you had invested $10,000 into the S&P 500 20 years ago, you'd have $65,000 by now, or more than 6 times the initial amount. I know we can't go back in time, although I wish we could sometimes, but it's not too late. 10 years, 20 years will go by in no time, and if you start investing now, your future self will thank you. Among so many investment choices, why ETFs? The majority of my non-crypto investment portfolio consists of ETFs. Now, why have I made ETFs such a large chunk of my portfolio? And what do ETFs have that stocks and mutual funds don't? By the end of this video, you'll understand why ETFs are particularly great for beginners. First things first, what is an ETF? It's best described by this analogy. An exchange-traded fund, ETF for short, is an investment fund that lets you buy a large basket of individual stocks or government and corporate bonds in one purchase. Think of ETFs as investment wrappers, like a tortilla that holds together the component ingredients of a burrito. But instead of tomatoes and rice and lettuce and cheese, these burritos are filled with stocks or bonds. So instead of investing in individual stocks, bonds, or other underlying assets, which are the ingredients in your burrito, and having to decide which ingredient you find most tasty, you get to pick the whole burrito with all the ingredients instead. Note here though that technically you don't own the stocks or whatever securities are inside the ETF. Now there are different kinds of ETFs based on what is held in the ETF. Some of the most popular ones being equity funds, fixed income funds, commodity funds, currency funds, and real estate funds. Let's just zoom in on equity funds for a moment. An example of a popular one is the VOO, the ticker for Vanguard S&P 500 ETF, or its Canadian equivalent, the VFVTO. These ETFs track the S&P 500. The S&P 500 is a stock market index that tracks the performance of 500 of the largest companies listed on stock exchanges in the US. This includes stocks like Apple, Microsoft, Amazon, Nvidia, Tesla, and many more. When you buy an individual stock, you actually own a slice of that company and get other benefits such as voting rights. And you might think that you can pick a winning stock and make a huge profit. And yes, this sometimes happens for people. For example, if in 2020 you invested into Amazon and held the stock until now, you'd be making a huge profit. But let's take, for example, Volkswagen. If you'd invested in the early 2020s, the value of your shares would have dropped by a lot. Now, professional and highly experienced investors like Warren Buffett specialize in analyzing companies to maximize returns. He has a whole team whose daily job is just to do fundamental analysis about businesses, looking at anything from cost structure, management, growth potential, and more. But the regular person just doesn't have the time or the skill to do that. At least I don't. And with that, exposes themselves to much more risks. And that's where ETFs come in. The biggest advantage of ETFs to stocks is diversification, meaning that instead of buying individual stocks, you are buying a basket of oftentimes hundreds of stocks. You are not dependent on any one stock going to the moon. Mutual funds are also diversified, but the portfolio is actively managed as we talked about earlier. In our example of the S&P 500 index, if you hold VOO or VFV, and let's say the share prices of 50 stocks within them go down by a lot, you still have 450 other stocks, of which many have the potential to pull the whole index up. That is why over the long term, you see something like this. Specifically in the case of the S&P 500, this index tracks stocks in 11 different sectors. Even if the share prices in one sector, for example real estate, goes down, you are still holding shares in 11 other sectors. But then you might say, I can just do my own diversification by selecting stocks I think will perform, also known as stock picking. Or why not just buy mutual funds? What is the difference anyways? The biggest difference between ETFs and mutual funds is that while ETFs are mostly passively managed, mutual funds are mostly actively managed. So the key here is passive versus active, and that's what you need to consider carefully when choosing funds. Active management, like in actively managed mutual funds, means that there is a fund manager who makes decisions about which stocks to buy and sell, in an effort to try and beat the market and outperform everyone else. And this is built on the faulty assumption that just because they did a ton of research and analysis, they will be able to pick better performing stocks and outperform the market every time. And as you can imagine, a lot of work goes into doing that. And that is why when you purchase a mutual fund, the management fees for that is usually higher than when you buy an ETF. But more about that later. And studies have shown that over the long run, ETFs have mostly outperformed actively managed mutual funds. Passive investing does better most of the time. 93% of US active managers in large companies were unable to beat the market over a 20-year period ending December 31st, 2023. And sure, the price of an ETF will also fluctuate by a lot on a daily basis, and that is why I prefer to hold my ETFs and other investments over the long term and refrain from buying and selling, trading them every day. Yes, the best funds can beat their benchmarks, often the S&P 500, in a given year, but over time, it's tough for active managers to outperform. In passive investing, the goal is not to beat the market as is usual for active managers. Instead, passive investors are simply looking to be the market. And if passive investing outperforms the vast majority of investors, it also means you can beat most active professional managers. So this is the reason why I myself mostly stick to ETFs, because I simply believe that I cannot outperform the market. And I don't have the time, or I don't want to spend hours and hours of researching and analyzing which stocks or mutual funds are the best, only to end up realizing that I was wrong. Now, why do I still invest in some individual stocks? I guess that there is always some part of the human psyche that thinks that it can be right on something sometimes and takes the risks. Now, going back to the fees. If you're buying a stock, you don't have to pay a fee as in a management fee. Although on some investment platforms, there may be a commission fee to purchase the stocks or the ETF, and you definitely don't want to do that. An investment platform that I've been using for over 3 years that doesn't charge any commission fees to buy stocks or ETFs is Wealthsimple. I like it a lot because it has such a simple interface which is really easy to use and intuitive, especially for beginners. If you want to try it out, you can use my link in the descriptions down below, and once your account is funded, then both you and I will each get $25 as a bonus. So if you buy stocks, there is no management fee. But if you buy ETFs and mutual funds, there is a fee known as an MER or management expense ratio. This fee basically covers the operating expenses to manage the funds. And the difference can be quite large. The average Canadian equity mutual fund MER is about 2%, but it's not uncommon for them to climb above 3%. By comparison, the typical MER for equity-focused ETFs is about 0.54%, and apart from a few exceptions, they are almost all below 1%. And I know 1%, 2% doesn't sound like a lot. What difference does it make? While the difference between the MERs for a mutual fund and ETF may seem small, it can add up over time. Consider the impact on a $1,000 annual investment earning 5% over 15 years. A 2% MER for a mutual fund costs you $3,500 in fees over that time, whereas an MER of 0.54% would cost just $1,011. After factoring in returns, it would mean the difference between owning an investment worth $19,157 or $21,646. Now, one question you might have is, if I invest in ETFs, will I still get dividends if there are any, as I don't own the underlying asset? And the answer is yes. If you buy an ETF that holds stocks that normally pay dividends, then yes, you too, as the ETF owner, will get dividends as well, mostly just on a different timeline. So, ETFs are diversified, they outperform most actively managed mutual funds, and in general stock picking, they are less work and they are also cheaper. And very important, yes, you can also invest in ETFs in your TFSA or RSP and enjoy tax benefits. I have most of my non-crypto investments in ETFs, as I said in the beginning of the video. But crypto, specifically Bitcoin investments, are forming a larger and larger share of my overall portfolio. The world has changed, and so do our investment strategies need to adapt. A video for some other time. So if you want to finally start investing, don't forget to check out the Wealthsimple link below. As always, thank you so much for watching, and I'll see you again soon.